Hello everyone and welcome to episode 2 of UnWine with the Twins of Real Estate. I'm Tasha Lyons.
I'm Joy Fair.
And we have our special guest, Miss Kia Coppedge.
Hello everyone.
So just introduce yourself to everyone.
Well, I'm Kia Coppedge. I'm a native, born and raised in D.C., lived all over D.C. and Maryland. And I got introduced in the industry through my uncle, actually.
Okay.
Yeah. So 19 years ago.
Wow.
19 beautiful years.
Yes.
Okay. So we've gone through the good, the bad, the ugly, and it's back good again.
Yes.
So, but I have a huge passion in giving keys,
Okay.
to the clients. That's my joy.
Mm-hmm.
I like to go to the settlements to see them get their biggest prize
Right.
of ownership.
Right.
So it's a passion thing for me.
Okay. Awesome.
Yeah.
So this segment is called Don't Whine About Bad Credit.
Mm-hmm.
Okay. So if it calls for a sip, right?
Yes.
So there's a misconception that you have to have perfect credit to purchase a home. So can you get into a little bit about where your credit score need to be when it's time to purchase a home? And let's say I have a client that they have less than perfect credit and they can't qualify. What options do you have for them? And just get into that a little bit.
Okay. Good question. It is the hottest question out there.
Okay.
Most people think they're worse off than what they really are. So I just say to speak to an expert first.
Okay.
The lowest credit score that programs are accepting is 500.
Wow.
Oh wow. 500?
500.
Hmm.
Now,
Okay.
don't be proud
Right.
to have 500
Right.
credit score, but it can get you in the door. However, you need some money
Okay, got you.
because you also have down payment assisted programs out there, and they won't touch a 500.
Okay.
They start at 620 at least.
Okay.
So if you're looking for assistance to help with down payment costs, then you want to speak to an expert who can help you get your credit score up.
Okay.
Especially if you don't have the necessary monies out of your, bank accounts and your investment accounts to pull from that to buy your home
Okay.
at a 500.
Okay.
Okay.
And is that something that you can help them with? Let's
Of
say they
course.
have to, okay.
Yeah, I educate throughout the entire process.
Okay.
And the first thing is credit. Because credit determines whether we're going to move forward in the process
Okay.
or whether we need to do some homework.
Okay.
And the homework is either credit homework or homework in other areas based on your profile. And so it doesn't matter where you stand to make that phone call to talk about home ownership. If it's not for you today, it can definitely be for you tomorrow.
And that's something that we stress to
Yeah.
our clients. I'm a firm believer of, okay, just take that step.
Right.
That's all it takes.
Don't be afraid
Yes,
of it.
and my passion is helping first-time home buyers because a lot of them think that they cannot. They have to have perfect credit and they have to have so much money saved up and they're just not in a position to do it. And then once I send them to you, they're like, oh, I was closer than what I thought.
Right.
Yeah.
And they end up paying less for a mortgage than they do for their
Their
rent.
rentals.
99% of the time.
Yeah.
People in credit, it's a relationship thing. And I know that when I was coming up, growing up, not in the industry, but outside of the industry, no one sat me down and taught me credit.
Okay.
Right.
My parents didn't sit me down
Right,
and talk
right,
credit.
right.
They didn't even sit me down and talk about money,
Right.
and bills and the real world in that case. We learn by trial and error.
Right.
And it's okay if you're not there. If you're not, if you're at 500 or you're still in the fours.
Right.
If it's seen in 3,
I hope
I haven't
not.
seen it 3. But if you're in the 4s, I'm going to say it's okay because you've had relationships with these creditors based on what you knew how to do,
Right.
or based on bumps and bruises that were not your fault.
Right.
We've all been there.
Absolutely.
I've been there.
Right.
Absolutely.
But it
Yes.
was bumps and bruises that were not my fault. Even if it was your fault, you probably didn't even know.
Right.
And so that's why the education is very key on where you are today. The best thing about credit, you can always change it.
Yes.
Like that.
Yep.
Yes.
You can change it. So if you have the proper education, we teach the game, the
Okay.
credit game.
Mm-hmm.
So if you have the proper education, and then what to do
Mhm.
with every type of creditor, and how to get out of the bad relationships with
Mhm.
creditors, then you're going to flip it,
Right.
and then you're going to be in, home ownership status.
Okay.
That's awesome.
Yeah.
Yeah.
Now, what type of mortgages? What's the difference? Which ones are out there, and how do you find out who qualifies for what?
Great question. So there are many different type of mortgages. You have your traditional
Okay.
mortgages, FHA,
Okay.
conventional, VA. Now FHA is normally for first-time home buyers. They are more lenient on credit,
Okay.
but they're strict on the properties. Right?
Okay.
You have conventional. They're more lenient on the property, but they're strict on credit.
Okay.
Okay.
And then you have VA. Well, you got to marry a veteran to get that one. So.
Okay.
But they do have some favoritism towards credit for veterans, of course,
Okay.
because they took care of us.
Right.
But let's start with FHA, because if you are in a situation where your credit scores, you've had some bumps and bruises, then FHA is going to be your friend.
Mm-hmm.
Okay.
And you do have some extra fees that come with that, upfront mortgage insurance fees, and then monthly mortgage insurance fees for life.
So can you explain to them what mortgage insurance
So-
is without getting too in
No,
depth?
the best thing they need to know about it, it protects the lender
Okay.
in case
Okay.
you foreclose.
Okay.
Okay.
Oh, okay.
Gotcha.
Okay.
It's insurance, just like
Right.
we get insurance on our cars,
Okay.
insurance on our lives.
Mm-hmm.
It's insurance, and so it protects somebody else.
Okay.
Doesn't do anything for you,
Okay.
but you have
But
to
you
pay
paying
for
for
it because you pay for it. If you want this property, if your situation is where it is,
Right.
and
Okay.
because it's lenient on the credit, that is the program that most people have to take.
Gotcha.
Now, you can get out of that program over a period of time by refinancing, and you got some equity in your property and you have better credit
Mm-hmm.
portfolio, because conventional
Right.
is strict on credit. But if you play the game that I teach you,
Mm-hmm.
you can get out of the FHA loan into a conventional loan, and then you don't have to worry about the mortgage insurance.
Okay.
At least in some cases.
Okay.
Okay.
Yeah, conventional still have mortgage insurance as well, but it's
Okay.
not mandatory for the entire lifetime of the loan.
Okay.
Okay.
Yeah. So, in a nutshell.
Okay. Cool. So what about the other loan programs? What's the difference between, okay, so FHA, we know that they're strict on, what'd you say?
The property.
Yeah, the.
You need another one?
No, I don't need it. I think I could put this back. Off of 2 steps, right?
No, but
I don't need that one. But what's the difference between the like the conventional and then there's a USDA loan as well, and the VA. So I know you said the VA is more lenient towards the credit score and stuff like that too. So what's the difference between those?
One of the major differences is how much money you have to put into the transaction.
Okay.
Okay, so let's start with the FHA one. It's 3.5% of the sales price that you need to put down. So let's say the sales price is $100,000. That's $3,500, right? And then you have closing costs. Always 2 parts of fees in every transaction.
Right.
And the closing costs, those are third-party invoices that are charged to the client that is paid at settlement.
Right.
And so that averages about 6% for this area, right? So if you take that same $100,000 loan, that's $6,000. So you add that to the down payment, you're looking at a $9,500 investment.
Right.
So the whole name of this game is OPM, other people's money.
Yep.
Okay.
And that's what we look at to down payment assistance programs to help with the down payment portion of it. And then we also look at the sellers, ask them for a portion of this closing, and we can take that $9,500 and get it down here.
Okay.
So it's all about your profile, one. It's all about having good representation, like you two ladies, to negotiate with the seller. And then we put it all together, and wow, you got your goal accomplished, especially based on your profile, how much money you actually have in case the seller is not willing.
Right.
It's not obligated.
Right.
It is your fees. We're just looking for other sources
Right.
to help you with minimizing those those costs. And so that's FHA. Now, the seller can contribute up to 6%, meaning all of the closing, which is great on FHA. So we have a generous seller.
They're few.
They're few. You know, then you can get away with having a down payment program, closing costs taken care of. Few. Okay? It doesn't happen on every transaction. Conventional. You have some 3% programs.
I like it. I like
You
it.
have 3% programs, meaning 3% down. You have to qualify for that. And you also have a 5% down payment program for conventional.
Okay.
But here's the catch. The max the seller can contribute is 3%.
And that's for
Conventional
conventional,
financing.
okay.
So instead of FHA, where the seller can contribute all of the closing, conventional, they're capped.
Okay.
And so it's very, very important because if they don't, the client don't have funds.
Well, I keep drinking. It's so good. I'm sorry.
So if the client doesn't have funds, you know, then
Okay, wait.
I would
not
suggest-
not to cut you off because we're talking about this wine. Let me introduce this wine, okay? This is Secret Grapes. It's a red wine. It's sweet. It's really good.
it really is.
Yes, and this was gifted. I'll probably get real chatty towards the end of this segment because I'm not a wine drinker. Yeah, I'm my tolerance level is really low.
Yeah, she gets the little
It
ones.
is.
She gets like the little shots, and they last forever.
The ones coming a little.
Yeah, the one like the Southern home one. Like,
So this was gifted to us
Can they see
by
it?
I don't know. This was gifted to us by Dante Douglas and Shondale Douglas. Thank you guys so much. Another one of my clients.
Yes.
They seen us doing the segments and said, okay, I got a bottle that you guys need to try. And this is 6 grapes. It's delicious. I like it.
I like it a lot. Let's see what the
Really good.
proof is on this stuff real quick. Just real
Now you check the proof.
Yeah, I check the proof.
I got the tape roll. I'm supposed to do that.
Where is the proof? Make it. She's not. Oh,
And I keep
okay.
saying I'm going to sit it down and I just
Right.
keep putting it
It's a lot. Right?
What is that?
That's
Oh,
It is.
you should stop. Tasha has to stop. Tasha, you don't drink anymore.
It's 19%.
Is it
alcohol.
really?
Oh,
You're gonna be dancing.
No, I forgot the difference between each shit. I'm saying you. I know this stuff. Do this every day.
that's so funny.
Ooh, I like it.
Yeah, that's good. Good job.
I'm gonna turn the tape on her in a second.
Okay, I have a question.
Yeah.
Well, will you finish with your
Yeah.
follow-up question with that?
But can I finish?
Sure,
on that?
yeah, no,
You had
certainly.
2 more. So we did FHA conventional.
Right.
VA
VA
is no down payment. So for a veteran, a veteran and a spouse are the only 2 who can go on a loan.
Okay.
But there's no down payment, and the seller can contribute
Wow.
all the closing as well. And then you have USDA. There is no down payment, and the seller can contribute. You know, but the USDA is really based on the its income,
Right.
household income
Right.
eligibility, and the property also have to be in an eligible market.
So that's what we're doing now. So we're
Yeah,
getting our
we're
house
getting
built
nice.
and
Yeah.
no, that too. That too. But we're getting our house built and we're under a USDA financing. Yeah, I'm so excited. But that's what I found out. I didn't know because, the loan is just in my husband's name.
Okay.
So, but they had to get my income as well. And I'm like, well, my thing not on the loan, but they don't care.
Oh,
Every-
really?
Yeah,
Everybody
because
in
in
the
the
house.
Yeah, it's household income, and then based on the size of the house, right? So we have a party of 5. So
The number of people
The
in the
number
household.
changes,
Yeah.
right?
Yeah.
Okay.
Well, no. Based
No.
on the number of people in the household,
Okay.
like a party of 5,
Uh-huh.
you can't say you have 10 kids and look on the tax returns you're only claiming 2.
Right,
So you can't
right,
do that. So
right.
they're looking at everything.
Right.
All the income from everybody in the house, so if you're getting income from the children,
Yeah.
all of that stuff. But they add it up and it can't be, it has
Right.
to mix
Right.
within the qualifications.
But it's
So
a wonderful,
it's an awesome program.
yeah.
It's an awesome program. You the MI is, it's pretty much I think it's eliminated. I think it's eliminated or it's reduced, one of the 2. It's the bottom.
Dante and Shondell, it's your fault.
I love it.
You must have knew this was gonna get us.
It's really good.
You know, you did that on purpose.
But yeah, you have you know, some reduction in your cost, your monthly
Right.
payment as well with that. So
Right.
it's good. It's a good program.
Okay.
Now, are there? We have a lot of first-time home buyers, right? And even second home buyers. So, what programs currently? Because I know that changes frequently. So, what programs are out there right now that you see are really benefiting your clients?
Especially first-time home buyers.
Well, now, program as far as loan or down payment?
Down payment.
Okay, so I've been using Chenoa.
Yeah, I'm
Chenoa
familiar
has
with
been
them.
my favorite.
Okay.
And majority, I haven't even turned away anybody from Chenoa. You know, getting money from Chenoa. Chenoa pays the down payment, 100%. So if the down payment, which is 3.5%, if you're going FHA, it will pay. If it's $10,000, if that's what it is, it would pay the $10,000 for you. There is a fee to use the program, but it offsets, you know, the closing. I believe we used it
Yeah,
on.
we did.
Was it
That
all
was-
the clients we've done? Did we use?
I think so. Yeah.
Wow.
Yeah. So you have that, and then they also have a model for conventional as well. So they do the 3% for conventional.
Okay.
But you know, it's less red tape to qualify for it. It is income based, but the way they have it set up, pretty much everybody qualify.
Now I
So
know
it's a good program.
some of the DPA assisted programs. I know some of them like
Run
run out.
restriction.
Yeah,
They
or
run
they
out of
run
money,
out,
or it's
yeah.
very hard. Like your debt to income ratio can't be over, you know, like 40-something%,
Right.
and that's impossible. You know,
Right.
at least Chenoa lets you do 50, over 50%, and if you got a DU approval, meaning an online underwriting approval, desktop underwriting approval, then it will allow you to have whatever DTI as long as it went through the system and got approved, and so it's very flexible.
Okay.
But it's very easy. I can still close a loan within 3 weeks with that program. We've done it.
Yeah.
We've done it, and so I love it. That's the best one.
Okay, now because we're in real estate, so we're self-employed. I'm a dual agent, but we're self-employed, and then there's a lot of our colleagues are self-employed. So what self-employed programs are out there?
Great question. The number one program is bank statements. The bank statement program, because most self-employed individuals, all your money goes into the bank statement.
Okay.
So first, you want to have a business account. You do want to have that.
Okay.
Now you can do it with your personal account as well.
Okay.
So it's
Okay.
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 But you know, you want to funnel all your money from the business to the business account. We have bank statement programs that's 2 years, meaning we'd take 2 years of all the deposits coming into your bank statements.
Okay.
And we average that over the 2 years to come up with your income.
Okay.
But that program, you got to have a CPA to do their CPA letter. You know, they have to look at your books and they have to do the expenses minus the deposits and give us that raw number.
Okay.
And so, but you have a 2-year program, you have a 1-year program, you have a 3-month program, and it's getting even better. You only need a CPA letter program. So
What's the catch?
the catch is 10% have to be your down payment.
Gotcha.
Okay.
You only get financed 90% of the loan. So you gotta have some money.
You gotta have money.
You gotta have some money. The seller can contribute to the seller can contribute to your closing costs,
Okay.
right? And so, but the good thing about it is you're able to get in the house without having to use your tax returns as a business owner.
That's awesome.
You know, because most business owners using their tax returns, they won't be able to get financed.
Right.
Because
Right.
they itemize so much.
Yes.
And the income that we will calculate from that will be
Yeah.
right. And so, but they actually make money.
Wow.
And
Yeah.
that's a beautiful thing. Or they don't even want to provide all the documentation. You know, they want to provide as little documentation as possible. Bank statement program is
Okay.
one. I've done several of them, and I tell you, the clients that I've serviced with those programs, they are ecstatic. They love it.
Okay.
It was easy breezy.
Okay.
How long is the
Bank statement
process?
program, I would say at least 30 to 45 days.
Okay. Okay. So a
depending.
typical
Mhm.
then. Okay.
Yep. So it's the best program for
Okay.
business owners.
Okay.
Yeah.
Now, I did have one question from Instagram. Someone wanted to know, can you explain to them the whole debt to income ratio? And I think that's probably going to be our last question.
Good question.
Okay.
That's the last one?
Yeah. That 19% is kind of getting to me a little bit.
Good choice. I love it. I don't know how I'm going to drive home. We got to eat a little bit, but I love it. So the debt to income, this is how it works.
Okay.
Take all your debt that comes up on the credit report, the minimum payment. So you have your balances, but then you
Okay.
have the minimum payment that's due every single month.
Okay.
Plus your mortgage, the new mortgage payment that you're going to be paying. Add all of those up, right? And divide it by your income. So if you're on salary, let's say you are like, $50,000, annual salary, divide that by 12.
Okay.
Whatever that number is, you take your debt, divided by that number equals your debt to income ratio. And so that's what that is.
Okay.
And so most loans you can't go over 57 is the cap,
Okay.
for FHA.
Okay.
Conventional is 50.
Okay.
So that's another reason why people will use FHA versus 50 because you got more room. You can get more house.
Right.
Okay.
To do that loan. So that's debt to income ratio in your finance. Now, as far as income, we do count all of the income sources that you have. So not just your pay stubs, but your child support, your Social Security, your alimonies, your annuities, all of that is income.
Okay.
So you don't want to withhold that information. You want to get that to us because that can help you with your buying power.
Okay.
How much house you can afford. And it also makes you look good on paper, even if you don't want to go to the max. I think I'm talking even better now. Even if you don't want to go to the max, your ratios are going to be low. And so you look even better on paper.
That makes sense. That makes perfect sense.
Awesome. This is a lot of useful and informative information. I thank you so much for coming and explaining the loan process and everything and credit scores and all that good stuff.
Yeah.
So how can, let's say I have a client, they want to, see where they stand. How can they reach you?
Yeah, they can go to applywithkia.com. And that's APPLYWITHKIA.com. They can call me directly, 202-725-9843. And all of my social medias, the tag is Apply with Kia.
Okay.
So, but call me. I'm never too busy to service you. I may be a little tipsy today, so give me a couple of hours. Then give me a call. Calm down then. But give me a call. I am going to have you to do a full application. I am going to have you to provide me all of your documentation. Income and asset documentation so I can look at your full profile and then I can tell you where you stand and what needs to happen if you're ready to go, and then we can get the train moving.
Okay.
Yeah. According to your
Sounds
profile.
good.
Yes.
Yeah.
You have to make that first step, guys.
Yes, absolutely.
And don't be scared.
Yeah.
I'm telling you, I'm going to take you by the hand. We're going to walk across the street. We'll be celebrating you later.
Yes.
But it's easy breezy.
Okay.
Don't be scared.
Okay.
Awesome. Thank you so much. And this concludes episode 2 of UnWine with the Twins
Twins
Real Estate. All right. Cheers, you guys.
Yes.
Thank you.
So the next episode is going to be about first-time home buyers, and you have somebody in mind, correct?
Yes, I have Shawnita Ann, who's a first-time home owner. She just not too long ago purchased, and she's going to give her experience through her point of view of the home buying process.
Awesome. So we will see you then. Do not forget to tune in every Sunday, 7:30.
Yes.
Who done right?
Laugh again. I was getting her serious. I was